Everybody, welcome to Wiley Solution Walkthrough. This is for accounting tools for business decision making, 8th edition. This is problem 18-4. Textbook authors are Paul Kimmel, Jerry Weingant, and Jill Mitchell. The question used in the presentation is copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are yours truly and not the authors of the textbook or of Wiley. Okay, before we thank the bus driver, let's go ahead and take a look at problem 18-4. So Tannic Company's sales slumped badly in 2025. For the first time in its history, it operated at loss. The company's income statement showed the following results from selling 500,000 units of product. Sales were 2.5 million. Total costs and expenses were 2,590,000, is kind of shown over here, a net loss of 90. Okay, so management is considering the following independent alternatives. Okay, so before we get into the nitty-gritty of this, let's chart out where we are today. So let's go ahead and do this, right? We're going to use contribute because when we're going through and doing this, we're talking around, playing around with costs or expenses or volume. We want to go through and just chart this out. So we got sales less variable costs, got cost of goods sold, selling expenses, administrative expenses, total variable costs. And this is going to give us our contribution margin less our fixed costs. Our fixed costs are also going to be cost of goods sold, selling, and administrative. This is going to give us our total fixed cost. And this is going to give us our net income. Okay, so all I'm doing, and if you've been watching this series of videos, you'll kind of see that I kind of take the same approach with most of these types of things. I really want to understand where we are first before getting into different things. So we're going to have here units per unit total. Okay, so it tells us over here that I sold 500,000 units of product. Okay, so over here, and my total sales over here were 2.5 million. Okay, so sometimes I have to kind of back into these numbers. So my sales price per unit is going to be $5. How did I get that? Well, A times B equals C. So if I have A, I don't have B, but I have C. If I divide, 2.5 million by 500,000, I get the $5. Okay, so over here, we also know that if we had 500,000 units sold, we must have had 500 units of cost of goods sold, selling, and then administrative expenses. In terms of doing this on the per unit, for the variable, right over here for cost of goods sold, this is 1,590,000. This is 92,000. This is 68,000. So again, to figure out the per unit, this is what I'm going to go through and do. Okay. So my total variable costs right over here, again, for 500,000 units, basically $3.50 per unit contribution margin, $5 minus my total variable costs, $1.50. So over here, this is going to be 2.5 million minus 1,750,000 or 750,000. Remember, this over here has to equal when I'm kind of coming down over here and looking at this. So for my fixed costs or my fixed costs right over here, I've got for cost of goods sold, 550, 158, and 132. Okay. So my total fixed costs right over here are going to be 840,000. So my net income or my net loss is going to be $90,000. So all of what I just did there is what the problem actually went through and told me, right? So this is all coming from the question. So this is just, I didn't really solve anything yet, right? But you're going to see right now when we go through and we look at these different alternatives, this is going to be what's going to be very, very important for us to go through and do. Okay, so let's go ahead and take a look at this over here. So instructions. Compute the break-even point for sales dollars in 2025. So what they're asking us here is, well, what was our, in terms of sales dollars, what was our break-even? So to figure that out, what I can do here is to figure out, if I got my ratios, I've got break-even point in units, and then I have my break-even point in terms of sales dollars. So let's go through and take a look at that. Okay, so over here, my contribution margin per unit, sales price per unit minus my variable costs are $1.50. So this is $1.50. My contribution margin ratio is going to be 150 divided by my sales price per unit, or 0.3. Okay, so over here, my break-even point in units are my fixed costs, which are right over here of 840,000. My contribution margin per unit is $1.50. Okay, so in terms of units, I need to sell 560,000 units. Okay. Going over here, break-even point in dollars. Again, it's fixed cost, but I'm now going to be dividing it by the contribution margin ratio, and this is going to give me 2.8 million. So if I go through here and plug in the numbers, and again, I really want to encourage you to make sure that you really get an understanding of this. Just go ahead and do it. So to break even, we computed that this would be 560,000. Okay. Okay, so at 560,000, we're actually right over here, 2.5 million. And let's go ahead and redo this. Okay, I'm going to actually undo this here because what I have to do now. Okay, so this is at, I'm going to hard code this. This is at 5. Okay, so now if I change this over here, okay, so if I change this to 560,000, so this is now getting me to contribution margin of 840, which is covering my fixed costs right over here. And if we look over here, the sales of 2.8 million, this is the same exact one we went through and converted. So right over here, so our break-even point in sales dollars is 2.8 million. Okay, so compute the break-even in sales dollars under each of the alternative courses of action. Which course of action would you recommend? Okay, so here's what we're going to do for this one is let's go ahead and take our base case scenario and we'll come down over here. And I'm just going to go ahead and make the kind of similar changes. Okay, so let's look at alternative 1. Okay, so alternative 1 basically says over here, increase the unit selling price by 20% with no change in total cost, total expenses, or sales volume. Okay, so if I increase my selling price by 20%, but now going to basically be over here at $6. So now I'm actually at a profit. But what I'm being asked to go through and do is to compute the sales, basically the break-even point in sales dollars under each of the following courses of action. Okay, so what's going to be the break-even point in sales dollars? Well, my break-even point in sales dollars, as we kind of saw from this over here, is I'm going to be taking basically my fixed costs. My fixed costs have not changed, right? But what is my new contribution margin ratio? Well, over here, my contribution margin per unit, since I increased the fixed, since I went through and increased the, basically the sales price per unit, So this is now basically going to be $6 minus my variable cost per unit. My variable cost per unit are $350 still. So this is going to be $250. So my contribution margin ratio is going to be 2.5 divided by 6, or 0.416667. So if I use this over here and I get fixed costs, I get 2,016,000. Okay, so let's see if this works. So if my total sales are 2,016,000, okay, and I'm basically selling this for $6 a unit, my units now are going to be 336,000. If I come down over here, I basically have now 840,000, which is covering my fixed cost. So I know I've done this correctly. Remember, this is a lot easier to do on Excel. On an exam, I generally wouldn't give you this breakdown in terms of all like these different costs. But in any event, it's always kind of fun to go through and do this, isn't it? All right, you get to use Excel for the CPA exam. Okay, so let's go ahead and take a look at alternative 2. And let's go ahead and change this back. Okay. Okay. So let's see alternative 2. What does alternative 2 say? So alternative 2 is change the compensation of sales personnel from fixed annual salaries to total salaries of 60,000 plus a 5% commission on sales. Other than that, all their cost expenses have remained unchanged. Okay. So let's put that down here. This will be fun to do. Okay. Okay. So change the compensation of sales personnel, right? From basically from fixed annual salaries totaling 140 to total salaries of 60,000 plus a 5% commission on sales. Okay, so here's my problem. Okay, so change the compensation of sales personnel from fixed annual to 140 to 60. Okay, so if the fixed is right now 158, so this is basically going to reduce this by 140,000. Okay, so of my selling expenses, 18,000 is non-sales related. Okay, so, or non-salary related. So if I have 18,000 plus 60,000, this is now going to give me 78,000. Okay, so over here, my selling expenses are now basically going to go to 78,000. Okay. However, with this as well, is that if my selling expenses, so my contribution margin per unit, so my new sales commissions, did on the wrong one. Okay. Sorry to screw this up. Just give me a second. Okay, so alternative 2, right? Okay, so it tells me that this is 158,000. 140,000 of this is basically, so 140,000 of this is basically his annual sales salary. So that means that 18,000 of it is unrelated. So that means I'm replacing the 140 with 60,000. So this is going to be 18,000 and then 60,000 for a total of 78,000. So my selling expenses are now going to be 78,000. Okay, but at the same time, over here, in terms of my sales commissions, okay, so my sales commissions, This is going to be 5% of sales, or 5 times 0.05, or 25 cents. So my new unit variable costs are now going to be $3.18. Going to be $3.75 for a contribution margin of $1.25. So again, what I'm doing here is that my selling expenses before were $158,000. What it's telling me is that $140,000 of this is related to sales salaries, and I'm swapping it for 60. So that means over here, basically my difference is essentially now going to be, what was it before? This is 158,000. Okay, so 158,000. It's now 140, or it used to be one. So 18 is non-sales salaries. The 60,000 here is the new salaries. So basically my total fixed cost over here is going to be 78,000. Okay, now when it comes over here in terms of the break-even points, when I'm going through and looking at this, let's compute this on the new ratios. Okay, so my new fixed costs are going to be 760,000. My contribution margin per unit is now going to be $5 minus 375, or $1.25. Okay, my contribution margin ratio is going to be $1.25 divided by 5, or this is going to be over here of 0.25. So my break-even point in terms of sales dollars is $3,040,000. And let's see how this works. Okay, so we got alternative 2. And let's also do this too. Let's do the break-even point in units. This is my fixed cost divided by my contribution margin per unit. My fixed costs, my new fixed cost when I got rid of the salaries is 760. My contribution margin per unit is $1.25. So basically this means I sold 608,000 units. Okay. So if I come over here and I'm now basically going through and selling under alternative 2, so if I'm now selling 608,000 units, okay. So my new total variable costs are going to be 2,280,000. My contribution margin is now going to be 760,000. When I add these up here, now I'm going to be at 0. So if we went with, again, so with alternative 2, what was kind of messed up about it is the way that it was worded, because the selling expenses, the fixed balance selling expenses did not exactly match. So you had to kind of do some, magic here. And we also want to check our work too, because if the sales commissions are supposed to be 5% of total sales, just make sure that you take 3,040,000, multiply by 5%, and you're getting that 152. So if we went with alternative 2, we're going to have to sell 608,000 units to basically achieve, essentially to achieve break even. Whereas under alternative 1, we can go through and we don't have to sell as many. So what I would say is by raising the price per unit, because now we're in the post-COVID inflationary world, it shouldn't be a problem. But of course, then all this other stuff's going to go up. But as we look at this over here, compute the break-even dollars under both. Which course of action would you recommend? I would recommend going with alternative 1. So, but let's, for fun, just go ahead and take a look at the solution to this. And just give me a second. Yeah, so we're absolutely correct in terms of how we were going through and looking at this, because if you look at this over here, it's kind of going through over here. It's basically the effect is right over here is that you're increasing the amount of sales that you need to 3,040,000. And then this over here is by putting this over here, you're actually now lowering that break even point. So I want to thank you for joining me here today. I apologize if it wasn't as clear as it should be. However, what I would just tell you to do on all these exercises is just make sure you chart them out. Like if you can write them out, write out the scenarios, and then play around with the numbers. Because if you don't have the basis in terms of for which to go through and to do the work, it's going to be an absolute nightmare. So in any event, I want to thank you for being with me here today. And I also want to thank Wiley for allowing me to use these questions. And I look forward to seeing you on the next video. Have a great day.